Hi all, welcome to this tutorial. So in this tutorial, we are going to cover off-balance sheet financing. Off-balance sheet financing is an accounting method where companies do not include certain financial asset or liability in the financial record or in the balance sheet. While again it is legal, it is used to keep debt-equity ratios low, make the companies appear more liquid. Off-balance sheet financing is a method while the companies are using some of the asset but they are not showing that asset or related liability in their books of account or in the balance sheet. So why the companies are using off-balance sheet financing? This is to make sure that their financial reports are made more attractive and to make the all ratios under control or under the benchmarked control. So again, there are some restrictions or some thing we have to consider while we are using off-balance sheet financing to ensure the reporting accuracy. So the first operating off-balance sheet financing method is operating lease. Operating lease simply it is renting of an asset or renting of an asset. Instead of buying one asset, we are renting and we are using that asset. So as a result, normally what will happen? This rent will not show. This asset will not show in the balance sheet, and also the related liabilities also will not report in the balance sheet. But the companies again it can use this asset and generate the revenue and use it for its operation. So that is operating lease. It is rental. We are using a rented asset instead of owning that asset, and we are paying monthly rent to that service provider and using that asset. So here we need some changes happened here on the treatment of rental. So as a normal case, what will happen? For the rental, what we will consider, we will not add this liability and this asset in the balance sheet, but we are just reporting this as an expense in the income statement or in the income statement. So as a result, what can happen? This company have good asset turnover ratios when compared to asset, because the company is using that asset to create more revenue and more sales, but that asset not reported in the balance sheet. So just assume if you are comparing one company with the operating lease and the same another company with the company that purchased that asset can have different result, because one company is using operating lease as a method to finance that asset or to use that machine, but the other company is directly purchased that asset. So once we purchase that asset, the related assets and liability will report in the financial statement. So as a old treatment, normally what we'll do, once the asset received, we will expense it is monthly, or what we call the monthly rental expense, we will record in the income statement. If you bought or we have purchased that asset, what we will apply the depreciation as monthly expenses, and at the same time we will report that asset in the balance sheet as well. But in the case of operating lease, which will not report the asset in the balance sheet, instead it is reporting a monthly rental expenses only. So again, as we know, the IFRS 16, it is against the rental or the rental asset or lease. It is now suggesting to use the right of use asset to capitalize and the lease liability as liability if the rental period is more than 1 year. So as a current treatment, we are considering both the operating lease and finance lease must now be recognized on the balance sheet as right of use asset and the lease liability. So the old treatment for the operating lease is pretty simple. We are just expensing that monthly expense in the income statement, that's all. But in the current treatment or in the new treatment as per IFRS 16, which is recognizing the asset as right of use as the asset and the related liabilities also reported in the balance sheet. So the corresponding depreciation is passing to income statement or profit and loss account. So as a result or as a summary, what we can say, if a company is using the off-balance sheet financing, it should disclose in the footnote that the company is using the operating lease instead of hiding that the company is using operating lease. then only the intercompany comparison will become more meaningful. So this is about operating lease. So let's move into special purpose entities. Special purpose entity is nothing, it's just creation of a separate legal entity by a parent company to isolate a financial risk or carry out a specific project. Suppose a company want to run a specific project, it has a high risk and it include a high debt also. Just assume. So instead of doing it itself, that company itself, what it can do, it can create a separate legal entity for this specific purpose, and by creating this, that can remove that asset and related liability to that special purpose entity. So there is a parent company already here, and this parent company creating a special purpose entity for the purpose of a specific project which is carrying higher risk. So as a result, what is happening? This company is actually transferring its risk, its liability, its asset to this special purpose entity. So as a result, this will not report in the parent company financial statement, or the related liabilities and asset will not report in the parent company financial statement. Instead, it will report only the special purpose entity. So the investment of the special purpose entity will consider as an investment in special purpose entity in the parent company. So as a result, what will happen? The special purpose entity, as a result of special purpose entity, the parent company's balance sheet will appear more attractive to investors, because it will not report that special projects related risk and asset in its balance sheet. Again, the parent company will transfer the related asset to this special purpose entity, and the special purpose entity borrow money to fund operating using its asset as collateral. So the related assets will transfer to special purpose entity, and this special purpose entity will borrow the required fund for this entity. So as a result, the borrowed money or the debt will report only in the special purpose entity, not in the parent company. So the off-balance sheet what is the benefit of this for parent company? If the parent company does not have a control under a specific accounting rule, the special purpose entity heavy debt do not appear on the parent consolidated balance sheet, because the special purpose entities normally are creating for a specific project which may carry higher risk. So this special purpose entity don't want to include that risk and that related debt in its books of accounts. That's why it is creating a special purpose entity. So again, as a legal, this is a legal way to do the special purpose entity, or to transfer its own risk to a special purpose entity. Again, if you are using special purpose entity in your business operation, you should disclose you are using special purpose entity in your company's financial statement as footnote. Again, why this is important as a financial analyst? We have to see if this company have created any special purpose entity to move its risk. Again, as a final result, if the special purpose entity is in the risk or in the bankrupt, definitely it will happen in the parent company also, because both have the same management and same the ownership. But to make more attractive this financial statement, to make it more attractive, that's why they are using special purpose entities. Then the third method is factoring of receivables. Factoring of receivable is a method where a company is selling its receivable to a factor or a third party and collecting that money. As a result, what will happen? This company can, suppose a company A have a receivable of 1 million, just assume, and there is a company B which is providing factoring services. So this company have some immediate cash requirement. So what company A can do? He can sell his total receivable, suppose for 9,500,000 to this company. Sorry, 950,000 to this company. So 50,000 will be the profit for this factor in this transaction. So this is a sale of account receivable to a third party to have immediate liquid cash. If this company want immediate liquid cash, he can transfer his or he can sell his receivable to a factor or a third party. So after once he sold this his receivable, as a normal case, the parent company or company A don't have any control over its receivable once it is sold. Then this company B will collect its all receivable, and if and this 50,000 in this example, the 50,000 will be a profit to company B. This is how the factoring normally happens. Again, there are two types of risk are there. The first one is factoring without recourse and factoring with recourse. Factoring with recourse mean if this company, this factor not able to, if the company not able to connect its receivable, it can sell back or it can transfer that same receivable to company A. That is with the recourse. Factoring without recourse mean the factor assume all risk. The factoring without recourse mean in this factoring without recourse, all the risk will transfer to this factor company. So as a result, if something not collected, again that all risk will going to transferring to this factor. So again, if you are using factor, as a result, what is the benefit for this parent company? It can have more liquid cash or more quick ratio or more liquid ratios can be seems better positive or in a better position. So again, if you are using factoring as a source of fund in your business, you have to disclose that in the footnote. Again, the off-balance sheet impacts will improve the receivable turnover ratio. If you are transferring all this receivable for a cash, definitely it will improve your receivable turnover ratio. And again, it will create a new expense in your company, that is this commission to this factor. This will create as a new expense in the company. So let's move to next special purpose entity, that is next off balance sheet financing, that is joint venture. Joint venture almost similar to special purpose entity, but only difference is in the special purpose entity, one parent company is creating another entity to carry forward its special project. But when it comes to joint venture, two or more or multiple parent companies creating a special purpose entity or a joint venture to carry out to a specific project. Suppose two companies focused in a same area, so they can combine and they can create a joint company or joint venture. So through this joint venture, they can pull the fund and they can carry out with that specific task or a specific project. Again, the joint venture is again similar to special purpose entity. It will not show the joint venture company's liabilities and asset in its balance sheet, in the parent company's balance sheet. So in this case, you will have two or more parent companies. Suppose one parent company and two parent company. They are joining and they will create a joint venture. So as a result, they will transfer all these risks to this joint venture and they will report only the investment as a long-term investment in their balance sheet. These parent companies will show only their investment in the joint venture as a investment in a joint venture. They will not show this joint venture liabilities and asset on their books of account. So the same result as same to special purpose entity. This will improve the ratio or financial performance to be more attractive for these parent companies, because it is not showing its risk like its long-term debt and assets in its books of account. So as a conclusion, why companies are using off balance sheet financing? The first one, the debt covenant. Debt covenant mean there are various ratios related to debt. So if the companies are using off balance sheet financing like joint venture and special purpose entity, they can transfer this debt into a third company, so that debt will not show on their balance sheet. Then the ratio management. So as we discussed the same, so it can improve our ratio performance, the parent company's ratio performance, if these companies are created some special purpose or some joint venture to carry out a specific high risky project. Again, the risk sharing. Again, these joint venture and special purpose entities allow the company to share its risk. Suppose if a company have with a higher risk, and so it can create a special entity to carry out that risk instead of affecting that risk the entire corporation or entire organization. Again, the lower cost of capital. So as of balance sheet financing, the balance sheet can be appear more clean or more attractive. So it can attract new investment opportunities, and definitely it will help to reduce the cost of capital. Then the liquidity as a final, we can say it is liquidity. Again, the factoring of receivable is an example for liquidity. So this company, if some companies need immediate money or this company need immediate money, what it can do, it can factor its receivable to a factoring agent, and it can immediately liquidate its receivable. So what we discussed today is special purpose entities. There, what we discussed first one, the operating leases, then special purpose entity, and the joint venture, and factoring of receivables. These are the methods, some 4 methods for off balance sheet financing. Then if you have any doubt in these topics, please ask me on the comment section. Thank you for watching this video.